Good morning, everybody. This is Boris Schlossberg. Hope you guys can hear me well. Type in the question box and let me know that you guys can hear me. And I know you guys are seeing my screen because I'm looking at the screen myself. So we're going to start the Eightcap Trader Zone today for September 7th, 2022. Very busy week, although no U.S. data today this week is of any material import. But there's quite a lot of data in the rest of the world, and we're going to go through that. Take a look at how the markets are absorbing everything and discuss the major themes. Feel free, as I said, to post any questions you guys like here, and I'll take a look and happy to answer anything that's on your mind. Let me see if I can just actually see. Okay, I got it. Very good. You guys can post any questions. I don't see anything posted so far. All right, so let's start with the most important screen of the week, which is the central bank screen. We've already had the Australian central bank raise its rate to 235 as expected, basically sort of 40 basis points, is that 85, 95? Yeah, I guess now 50 basis points, according to my math, kind of an awkward raise. And we'll take a look at the Aussie and how it's reacted, although the statement was a little bit less hawkish than people thought. So, we'll see if Aussie is kind of suffering from expectation issues. Now, what's coming up next is actually, as far on the central bank page, is the Bank of Canada rate statement today. There is no accompanying pressure with it. The market is expecting a very hefty 75 basis point hike. The Central Bank of Canada has already raised 250 basis points very aggressively already. And they seem to be, I think, trying to preempt the raise in rates by going hard at the beginning. It'll be interesting to see because, I think in some ways the U.S. bank may be taking a cue from Canada Bank. Here's the ratio of all the interest rates so far. New Zealand leads. Canada is at 250, US is at 250, Australia is at 235, UK is lagging, and UK is really, by the way, having a very, very hard time because the pound is super weak. Inflationary pressures in UK are enormous, but precisely because conditions are really recession-like, the Central Bank of England, is the BOE is having a very hard time sort of raising rates quickly into a recessionary environment. What I think is happening in all the other banks, like all the commodity central banks, is that the policymakers have decided if they can raise rates now to a large extent, they won't have to raise rates later, and it'll be sort of enough of a shock to the system on the monetary side, so that at the same time, while the fiscal side is spending money, that it's not going to trigger a full recession. So that one of the reasons why the Bank of Canada is going to be so interesting today is if they do go 75 bips as everybody expects them to, but then sort of say we're done for now because we think that's enough monetary tightening for the near term. That may be the path that the Fed takes. So right now, the Fed, everybody is focused on the Fed as to whether it's going to be a 50 basis point hike or a 75 basis point hike. And I thought it was going to be 50 basis point hike, but the more I think about these issues, I actually think it's going to be 75 because the central bank, the Fed, is going to essentially maybe follow this path. And the idea here for monetary policymakers is take the medicine early so it's preventative, and then hope that the economy can survive the initial shock, and then you won't have to raise rates anymore, and then the economy can just sort of absorb those rate hikes and continue to muddle along, which is the best course of action for policymakers. So it'll be interesting to see, how that goes on, and we'll see what the Bank of Canada says today as far as a clue to their forward guidance, which is really what it's all about. Now, the other big central bank that's on the docket is tomorrow's ECB, and that's going to be really an interesting, very complicated presser. The ECB is expected to raise rates to $1.25, 75 basis points, still lagging everybody else and everywhere else in the world. But having a much harder time, basically, having a much harder time, basically, trying to deal with higher interest rates amidst truly catastrophic conditions because of the energy hikes due to the Ukraine war and due to the fact that Putin has basically cut off all gas. Honestly, all of the forward economic prognosis that's going on right now is really resting on two things that are completely non-economic. Political factors. So the major political factor, of course, in Europe is going to be just how brutal the war will be with Ukraine, how tough Putin will be on the gas prices, but much more importantly, how mild the winter will be in Europe. If the winter in Europe is actually forecast to be milder than normal, if that's the case, Putin will lose badly because Europe, as of now, has enough inventory capacity to survive the winter without a single additional input from him. If that's the case, they survive the winter, he cuts off the gas, they will just cut off economic conditions with him completely. Russia, in many ways, I think is going to feel quite a lot of pain, both economically and if the Ukrainians can retake Kherson and retake some of the southern part of Ukraine, they will feel tremendous amount of pain militarily as well. If, on the other hand, winter is brutal, it could create just enormous amount of havoc politically and economically because Europeans will have no choice, perhaps, but to negotiate some sort of a cold peace with Russia. And that's going to put Russia into a tremendously powerful position vis-a-vis Europe going forward. So we'll see. We'll see how things go. That's why it's very hard to predict with any kind of certainty what the policymakers will do, how things will work, because really nothing at this point is dependent on economic factors, and everything. All the economic factors are dependent on political considerations as far as we go. So we really can only forecast a couple of days, a couple of weeks into the future with any degree of confidence. So let's take a look aside from the central bank policy. So basically, I think the key takeaway from all the central bank movements is that central banks have decided, let's raise rates fast now so that we don't have to raise rates at all going forward. So in other words, take the medicine early, hope it doesn't kill the patient survives, and then move on and hope to muddle on through moderate growth. Now let's take a look at everything else that's going on here. Sorry, let me just do all, and we'll apply the filter. And we'll just take a look at, first of all, what happened this week as far as data set goes. And the data set really, has not been as horrid as everybody expected. If you look at the services PMI numbers, they came in a little bit weaker, but nothing is really falling off a cliff as badly as people thought. As a matter of fact, you could make the argument that some of the ISM stuff, including UK and US ISM stuff, which is the US version of PMIs, has actually shown surprising resilience on that front. When we look at Italian retail sales, European employment changes, revised GDP, all of those things were actually better rather than worse relative to market expectations. Still obviously horrible, but not with markets. It's all about expectations, not what the actual data is. Now, going forward, really, as I said, the main things is going to be the BOC today. We're going to watch that very carefully. After that, U.S. unemployment claims just going to be a mild interest for us, just to see. One of the things that's been happening in the U.S. is the U.S. economy continues to be relatively strong as far as employment numbers go, which is part of the reason why the Fed may feel emboldened to hike 75 basis points. Also, we have obviously the chair talking tomorrow against the ECB pressure, so it'll be interesting to see. The thing with ECB pressure is it's hard to imagine Christine Lagarde being incredibly tough on monetary policy amidst literally warlike conditions in Europe. It's sort of very, very hard to talk tough on inflation when the population may be facing heating, literally life and death heating and food issues into the winter. So it'll be interesting to see how she tries to thread that needle. That obviously also leaves the euro still vulnerable to possible further sell-off, although it's been so badly sold off. I think unless there's an uber dovish statement from the ECB, unlikely it's going to go down much more. And then the last thing this week that's of really strong interest is going to be the Canadian employment change data. That also is in light of how the BOC reacts. As I said, the BOC is expected to go 75 bips, but if they come in there and say, listen, we're done, we're pretty much done with tightening for now, we think conditions have tightened enough, that may be a relatively dovish statement despite a rate hike, and we'll have to see how the Canadian data reacts. It's been relatively weak on the data front, so if we don't get a positive blip on the employment change, it would really put a huge amount of pressure on the BOC to actually not hike rates at all beyond the 325 limit, which is where they're going to stay. So that's sort of the broader economic picture. As I said, almost all of it is contingent on factors outside of the economy in many ways. Will Russia cave in and begin to pump gas? What's going to happen as far as deeper winter goes? How will the situation on the Ukrainian front develop over the next couple of weeks? It's all going to be very, very geopolitical as we go forward. So now let's take a look at our charts. I'm actually going to go. Let's look at the FX charts here, and we'll go through them one by one. I just want to go through the majors and kind of discuss. This is the hourly chart. This is, by the way, kind of a proprietary indicator that we use in our trading room. I'll share that with you in just a little bit. But it shows. Let me make sure that I have this correctly. Let me make sure I have it correctly set up. Yeah, it's set up on monthly. On monthly, yeah, we have just. This is the monthly high, the monthly lows. We obviously just started the month here, right? Is this the month? Yeah. Monthly highs, monthly lows. You can see the dollar CAD is in a relatively tight range between 32 and 30. It was weaker. Today's trading a little bit stronger into the BOC rate decision. And if they don't come out as dovish as everybody expects, then this break of the midline around 3140, 3150 level could trigger a potential move, to fresh lows. So be watching that very, very carefully on dollar CAD as the key element today. Now, euro ahead of the ECB is really just at bottoms of near-term bottoms here at around the 97, 98 level. It's obviously very, very weak. If we want to look at euro on like a much longer monthly basis, I sort of want to show this to you. And let me just go back to, you have to go back a tremendous amount of time. This is, I wonder how far back we can go. Yeah, we can go back to like, so the lowest we saw the euro was sort of just in the post .com blow up. It was at around 82. So there's certainly scope, for further levels to go. But the prior was 88, and I'm just kind of see where the big support levels are. It's 105s. It had a hard time clearing the 94s. I guess this 97 level, which is sort of a very, very, very long term. This was a resistance level. You can see it broke down. It tested it here before it finally staged a multi-year, long-term 150 gain. And this, by the way, is sort of, I think, an interesting point. Is remember, everybody was just as negative euro here as they are today, and yet then it tended to stage a massive, massive recovery move over multiple years. There is a lot of interesting reasons for why that could repeat itself. It's early, but if you're sort of a long-term trader, you could begin to possibly consider the idea that we're kind of trading near the lows, and there's definitely scope to go to the upside. So one of the reasons why this is a possibility, despite all this negative economic data, has to do actually with capital flows. Excuse me. If you think about this, European rates have been negative for literally decades, right? People who hold euros have had to pay money for the privilege of holding euros. So a lot of people who held euros have quickly converted them to dollars just to get positive yield. That's changed. Euro yield now is positive, right? Now, the second reason why a lot of people converted euros to dollars was because the US equity market was a perpetual upward rising machine. But now the US equity market is in a deep bear market and it's selling off. And a lot of those positions are starting to become unprofitable. Furthermore, the prospect of US equity market rally is becoming dimmer and dimmer. So there's like little reason to want to convert euros to dollars to buy US equity assets. If we get a further sell-off in US equity assets, and Europeans just simply create positive yield, that may be enough to tilt the capital flows to the upside. And regardless of how bad the European economic situation is, it may be just an adjustment on the capital account where investment flows will come back into Europe. So that means people will be selling dollars, buying euros, despite the fact that economics are really not improving. They don't have to. They don't have to improve. The main thing is they just don't have to get any worse. If there's a stalemate, if the Europeans are able to survive the winter, there's clearly some possibility after being so grossly oversold for such a long time for some sort of a bounce. So this 97 is the big support level. It's obviously always very, very hard to estimate exactly where the currency will bottom out. So when you're doing long-term trades, you sort of want to scale in and come in on it, at 100 pip, 200 pip increments, and be fully comfortable with having like a 500 to 600 point scale and zone in order to really establish your position. On a much more shorter level, like on an hourly level, there really isn't any clues for us that this is an upward moving trend yet. What we'd like to see, just on an upward level, using my proprietary bounce indicators, we want to see a green strip, a buying strip here first. And ideally, what I like to see, and we call this the double tap, and you can see this the other way too. When we get two consecutive selling zones, you see these little red labels showing you the beginning of each selling zone. We get two consecutive selling zones, that's usually a beginning of a relatively good trend to the downside. And we get two consecutive buying zones here. That's at least an indication of a possible upward trend beginning. So far, the upward retrace moves in the euro have been very weak over the last month or so, and the sell-offs have been brutal. But we're getting to a point where we're starting to make more modest, like we're not making any fresh lows, right? The lows have kind of held up. So we're not at a stage where the euro is a long, but we may be at a stage where it's no longer a short. And I think that's really important to understand when you're constructing your ideas. It's hard to chase us to the downside. And if you're willing to take some risk, you may want to just nibble at this. If you want to wait for better price structures, I would certainly wait until we start seeing more green flows to the euro as it goes. Now, cable is just been a disaster, right? And it's really hard to make an argument to be long cable on any kind of economic reasons. But on a technical basis, we are again coming to that stage where we're not making fresh lows. As a matter of fact, we've had our first sign of potentially buying short covering or value buyers trying to take their dip in. I don't know, what would convince somebody to be fundamentally long cable, given the complete mess that UK is in politically, economically, financially at this point. But that may not be the case. It may be the situation where you're simply so sold out that you have a small dead cat bounce. On the other hand, if you have a strong fundamental view that UK may not be able to work, to work its way out of its problems because it has isolated itself economically and has made itself vulnerable, on a million different ways through Brexit. There is a really strong fundamental case to be made that cable could go to parity. I mean, it's unimaginable for people to truly see that. But the whole idea of Great Britain being Little England really is not expressed any better and stronger than in the chart of the currency. So let's take a look at just super long-term chart, currency charts. This is the monthly chart. The lows here were pretty much here, the 17. This is I think, what was this? This is the Brexit lows, right? We had the Brexit lows came back, and I think this is the really key tell. We break the Brexit lows. Basically, we take out the 114 handle and take out the Brexit lows. There's no stopping us. You have to go back and back and back. I think we'll go 94. The chart goes to 94, and we were never at these lows before. So of all the pairs, this one I think is most vulnerable to the downside. And that actually, by the way, raises the prospect of, let's take a look at Euro pound. If you sort of don't want to trade this directly, you may want to trade this indirectly. And excuse me. And you can see that on the monthly chart of the Euro pound, right? First of all, we have a buying impulse here on the Euro pound on the monthlies that still remains for quite a long time. And these are monthly charts. So remember, you get an impulse on a monthly chart. This has been years, but it hasn't really gone down, and it also means that you could have a potentially big breakout going forward. Let's look at this example on a monthly. You have a monthly break, huge consolidation for years, and then a higher move to the upside. So depending on your time frame, this certainly looks bullish, and bullish in the sense that it's very bearish cable, right? On a much more immediate level, where we're on the hourly chart, this seems like just a mild correction on the red zone. If we reestablish, I would say that if we reestablish the green zone in the Euro pound on my indicator, you will certainly have very, very strong case for Euro pound to the upside as we go forward. And then finally, let's take a look at the yen as a trade, and we'll start. Let's see here. The yen is again at super fresh lows. There really is no surprise to this, right? Why is the yen so low? Well, because if you look at the interest rates, yen is still negative carry. It's still negative interest rates, and U.S. continues to expand its interest rates. So it just takes no effort to make money in dollar yen. Every day you get paid positive rates to hold dollars against yen. Even if nothing happens, you make money. So this kind of a brutal, one-way move up is just validation of the strong dollar trend. Now, as I said, the key question will be if the Fed basically says, okay, we're kind of one and done. We're gonna pump it. Maybe even if they pump it 75 versus 50 on the September meet, if they say, we think that's reached a relatively decent equilibrium level, that alone could create a little bit of a profit-taking rally. And it's hard to chase dollar yen at 144 when it's going to look for some breathing area. This kind of parabolic moves of four big figures, three big figures here, going to be really, really hard to be able to buy at these levels, I think. So I wouldn't want to be chasing this to the upside. But I do think that if it comes down into this level of 141, 140, it's going to be a very, very decent buy, just at a purely long-term fundamental basis. Japanese are really not looking to increase interest rates, and even if the U.S. increases rates at a much more modest pace, the spread between the two will continue to grow. So it's not unreasonable to think that dollar yen could continue could go to 150 basically as a trade. Let's go to the month. This is the monthly charts, right? Over a long term, and you can see, it broke every monthly high here. It's sort of trading at fresh parabolic all-time highs, and I think you really shouldn't worry about your long position until you get some kind of a red monthly candle. Only when you get a red monthly candle can you imagine, okay, that seems to be like an intermediate term top, and a pause on that candle is probably likely means that we're close. These type of parabolic moves in markets always get reversed. I mean, to me, it's completely not inconceivable that we could see 5, 6 big figures in a matter of 2 or 3 days correction, because you've had such huge buy-ups. Huge amount of people are long here, so liquidation could trigger it. But after you get that liquidation, you're probably going to get a halfway decent bounce. So I'd still be looking to want to pop it from the upside rather than from the downside. Anyways, those are the 3 major trades. The other thing I was going to say is the other trade that I actually think looks pretty good, right? Again, if you sort of believe that euro is pretty much sold out, and if you think the yen continues to maybe trade higher, is the euro yen trade over here. This is a big monthly resistance, 144. So this closes above 145. We may have more scope to the upside. Like, it's sort of, if you want to trade long dollar yen, maybe a more safer way to do this is through long euro yen for now. But those are the big major trends on a longer term basis. In the near term, we're really looking for just a near term clues. Overall, I would say pound seems the most vulnerable to the downside. Euro could see further downside action, but certainly it's closer to the bottom than it is to the top. And dollar yen, because of its parabolic move, is certainly due for a near term correction. Dollar CAD is the only one we didn't really look at on the long-term basis. Let's take a look at the long-term basis. Dollar CAD is nowhere near its long-term extremes. It's really sort of a consolidated phase, and I think it will stay that way. It's kind of a 34 to 28 trade around here. It really doesn't have much long-term clues for us to go with. It is starting to, as I said, trade down in anticipation of the Bank of Canada rate decision. This could be an interesting day trade if you guys are looking to maybe short it against the day's highs at 3,200, just on the assumption that Canada comes out at 75, maybe not as dovish as everybody expects, and that could test us to 3,100, maybe even 3,050 before I definitely think we're going to find some support here at the day's lows. So that's kind of how the week shapes up, the day shapes up. Let me see if there's any questions here for me. I don't see any questions. Feel free to type them if you if you have any questions. Happy to discuss any other issues. But those are, that's basically how the FX world is shaping up as we're entering into this week. One thing that I wanted to show you, while since I see there's no questions, I wanted to show you a couple of things before I let you guys go. If you're interested in trading with us, we trade live every single day. And Kathy, I trade live actually stock index futures every single day using all of the same proprietary indicators I just showed you. And Kathy trades live FX. And if you're interested in joining us, please go to bkforex.com and sign up. And you can see she's putting out trades right now as you and I speak, and she's actually short EuroCAD in anticipation of BOC rate decision being hawkish, and she's got her own proprietary indicator called zip indicator. You can see that on the zip indicator, it just broke through the key zip line to the downside. This white candle, suggests further weakness to the downside, and she's trading this continuity move, perhaps all the way down to the 130 level. So as she's done really, really well. I want to show you. Oops, let me see if I can I escape this. Okay, I wanted to show you this is her trading results just yesterday. I mean, it was crazy. She had a great day yesterday. She ran her results all the way up 155 pips in just one single day of trading on some very, very good calls. A lot of it on euro weakness that she's been really riding well, and some of it actually on euro yen strength. So feel free to come join us if you want to get some great intraday trade ideas. If you want to see my trading, let me see if I can actually pull up my, I trade a live account. Hang on, sorry, I just want to log into my FX book. Boris Daily. Here's my daily account. As you can see, here's my live trading account. We started with 100,000 and we're at 121,000. Pretty much, really, in the month of October, in the month of August, I really started trading it. So I day trade this live every day on the stock index futures. You can come trade with me as well. So hopefully, lots of interesting ideas. We'd love to have you in our rooms. Thank you for hanging out with us. Everybody who deposits money with Eightcap, if you already have an account, you can do a fresh deposit, and if you are already an existing customer, you can just do a new deposit. Let me just add this link. Hang on a second. I gotta find it. It's I think it's free membership. There it is. I gotta find this thing. We literally can give this membership to you for free. It's a more than $1,000 membership per year that you can get for free just simply for depositing money. I'm sending the link to you guys so you guys can take advantage of it. Super easy. Just drop money or add money to your account. Send us a screenshot of your deposit, and we will let you come into our room and trade with us. Anything that you guys like. Okay, so I don't see any questions. I hope everybody enjoyed this. I will see you guys on Monday for the restream, and then we'll see you next Wednesday for next weekly setup. Everybody have a wonderful day. Wishing you guys the best luck, the best of trading. Boris Schlossberg, over and out.